Module 7, Understanding Cash Flow Management. 1. The concept of cash flow. Definition. Cash flow refers to the net amount of cash being transferred into and out of a business over a given period. Why it matters. Ensures the business can pay suppliers, employees, and meet debt obligations. Determines whether a business can expand, invest, or survive during downturns. Helps avoid insolvency despite having profits on paper. Key principle. Cash is king. Without liquidity, even the most profitable business cannot sustain itself. 2. Types of cash flow. Cash flow can be categorized into 3 main streams as reflected in the cash flow statement. A. Operating cash flow, OCF, involves cash generated from core business activities such as sales of goods and services, includes cash received from customers, payments to suppliers, employee wages, and operating expenses. Indicator. Positive OCF means the company's operations are self-sustaining. B. Investing cash flow, ICF, related to long-term investments and acquisitions. 3. Difference between profit and cash flow. Profit is an accounting measure based on revenues and expenses, may include credit sales not yet collected. Cash flow measures actual cash movement when money truly comes in or goes out. Example, a company may record 5 million naira in sales, profit, but if customers haven't paid yet, cash flow may be negative. Many businesses fail because they confuse profits with liquidity. 4. Cash flow cycle. Understanding the operating cycle is critical for managing cash, purchase of inventory/raw materials, production and sales of goods, collection of receivables, payment to suppliers and creditors. The shorter the cycle, the healthier the cash flow. Businesses with long collection periods and short supplier credit terms face greater liquidity pressure. 5. Tools for cash flow management. Cash flow statement provides insights into operating, investing, and financing cash. Cash budgeting, forecasting inflows and outflows over weeks or months. Liquidity ratios. Current ratio equals current assets divided by current liabilities. Quick ratio equals open parenthesis, current assets minus inventory, close parenthesis divided by current liabilities. Working capital analysis, ensuring current assets exceed current liabilities. 6. Common cash flow problems. Overtrading, expanding too quickly without enough working capital. Poor credit management, allowing customers long credit periods without timely collection. Excessive overheads, spending more than the revenue stream can support. High debt obligations, excessive interest and repayment schedules, unforeseen expenses, emergencies that drain reserves. 7. Strategies for effective cash flow management speed up. Inflows, offer discounts for early payments. Adopt digital invoicing and automated reminders. Tighten credit control policies. Delay outflows. Negotiate extended credit with suppliers. Schedule payments strategically. Avoid unnecessary expenses. Maintain adequate reserves. Build emergency cash reserves. Maintain access to credit facilities for liquidity needs. Monitor. Regularly, weekly or monthly cash flow reviews. Use accounting software to track patterns. Balance growth and liquidity. Expand at a sustainable pace. Avoid tying up excessive cash in non-liquid assets. 8. Case example. A small business records annual profits of 20 million naira, but collapses because 60% of sales were on credit and customers delayed payment for 90 days. Suppliers demanded payment within 30 days. The business had to borrow at high interest rates to bridge the cash gap. Lesson: profit is irrelevant without liquidity. Cash flow determines survival. 9. Application for non-accountants. Entrepreneurs, managers, and administrators must understand cash flow because decisions like granting credit, expanding operations, hiring staff, or taking loans directly affect liquidity. Even if accountants prepare financial reports, Non-accountants must interpret cash flow to make informed business decisions.